was in high school when the great financial crisis happened, so I remember it quite vividly as something that came completely out of the blue, almost impossible to predict, like all major crises. Obviously, in hindsight, we know what went wrong, and that's why we should use that experience to think more critically about markets today. Just a bit of extremely simplified history first. So at the root of that financial crisis was the fact that big financial institutions all over the globe had their balance sheets full of debt securities whose underlying assets were non-performing loans. And we are talking billions of dollars in overestimated value. These instruments were theoretically high quality, but as soon as consumers started defaulting on their mortgage payments, it became clear to everyone that these bonds were actually junk.
Adjustables are bread and honey.
So do applicants ever get rejected?
Seriously? Look, if they get rejected, I suck at my job.
Well, even if they have no money?
Well, my firm offers ninja loans. No income, no job. I just leave the income section blank if I want. Corporate doesn't care. These people just want homes.
Which leads us to the following question. Who decides about the quality of a fixed income instrument like a bond? Well, at that time there was a duopoly, which is still pretty much in place, with two major credit rating agencies, Standard & Poor's and Moody's. All investors, sophisticated and retail, trusted them unquestioningly. The problem was that these rating agencies had a financial incentive in giving high quality ratings because they wanted their commission and didn't want to lose market share to their competitors.
If we don't give them the ratings, they'll go to Moody's, right down the block. If we don't work with them, they will go to our competitors. Not our fault, simply the way the world works.
Moody's in particular had gone public just a few years back, so they really cared in showing their profitability to investors, which made them very generous in assigning high-quality ratings.
Where are the ratings agencies at?
They're the same.
Nope, they're all still AAA.
What the hell? Are you kidding me? Those mother they go public and all they care about is their bottom line and their
Now, what does this have to do with ESG? Today there is essentially a duopoly in the ESG scoring market made of Sustainalytics and MSCI. Unfortunately, there's also the same level of complacency among investors. Just like in 2008, we all trust them, we as in the market, because they have the expertise, they have the resources, they know what they're doing, so we don't dig that deeply and check what's under the hood. MSCI has a scale for their scores which ranges from CCC to AAA. Now, 94% of the companies they score has a rating of B or higher, which might indicate that their criteria is not as stringent as one would want. Now, why are these scores so popular? On one hand, they're useful because they summarize a lot of information in one single metric, and they make ESG integration very straightforward for stock pickers. Another reason has to do with ETFs and passive funds. Professional investors usually love this type of funds. They're cheap, like 30 basis points or so. They allow you to build your portfolio and get exposure to different geographies, sectors, styles, themes, and they've done the job in terms of performance so far. Add to that today every asset manager is building a sustainable offering because of the demand coming from clients, and no one wants to be left behind in this trend. All of these reasons help understand why we've seen such massive inflows into sustainable ETFs built on the basis of MSCI ratings, with the biggest one having between 4 and 15 billion of assets. The risks to financial markets of this widely adopted approach is complacency, which we already talked about, but also crowding and mini bubbles popping here and there. But more importantly, there's the risk that this approach doesn't actually achieve what it was set out to do, which is pushing companies towards a more sustainable path. A great research article by the IMF finds that ESG scores don't really have a strong correlation with emissions growth. This means that large emitters who even increase their emissions year on year are not consistently penalized by lower ESG scores. On top of this, there have also been scandals involving highly rated companies such as Wirecard, which was a large German fintech. In 2020, the stock collapsed in a governance scandal because of accounting irregularities. That firm had strong ESG ratings from leading providers, which again shows that these scores can be quite opaque and conservative. This makes me wonder how painful it would be for markets if we saw this type of events becoming more common and investors losing confidence in the methodology and usefulness of ESG ratings. So this is what I wanted to share with you today. I hope that this video made you think about something different. I thank you so much for watching this far, and I'll see you in the next one.